Good morning, everyone. I'm Dr. Deborah Watson, an Advisory Services Manager from Innovate UK EDGE. I'd like to welcome you to our second Thought Leadership Series, Innovate 2021, looking at enabling ambitious, innovative SMEs to overcome challenges and build for growth. This series of webinars and workshops are running throughout the spring and will cover funding and finance, leadership strategy, and sales and marketing. Each event promotes the bespoke support available from Innovate UK EDGE and how we can add value to your future growth plans in this challenging environment. But before we properly get going, there are a couple of housekeeping items I need to talk you through first. At the end of the session, there'll be a Q&A. Please either ask questions in person or anonymously. These will be moderated. Raise your hand to indicate if you need any assistance. And please feel free to communicate with other attendees through the chat, but this will be unmoderated. For on-demand purposes, this webinar is being recorded. Your personal video and microphones will not be used unless you're invited to speak by the host. Today's session is hosted by Ed Tailwright. Ed is an Access to Finance specialist at Innovate UK EDGE in the southwest of England. Ed has spent his career working with private investors, business angels and venture capital firms. And he held roles at the Southwest Angel Investment Network, where he was involved in raising over £70 million in investment for Southwest businesses. Today, he will cover the do's and don'ts of pitching to investors. As participants in Innovate 2021, and subject to Innovate UK's eligibility criteria, there is an opportunity for you to access our comprehensive range of support. I'll discuss the next steps and how to access these services at the end of the session. But before I hand you over to Ed, a quick poll. If you could please try to scan the code on the screen with your phone or join us in a web browser at slido.com and use the code INN2021. I'll give you a few seconds to all scan that code or go to the website. Now the question is, what do you want to get out of today's session? So, would you like to get out valuation, negotiation, pitching, something else? Let's leave that poll active for a little bit longer, get some more answers in. We're still getting answers come in, so I'll leave it open for a little bit longer. Right, we've got a few answers come in now. So Ed, I hope you've got all of those things covered. And without further ado, I'd like to hand over to you, Ed, to start the session.
Thank you very much, Deborah. Yes, I did get all of those. So from that, very briefly, what we're looking for today in wooing an angel and the do's and don'ts of pitching to investors. A little bit of insight, pitch practice, a little bit on valuation, good practice, startup seed rounds, how we raid those, general guidance, getting cash, and then the do's and don'ts. You'll be happy to hear that we are going to cover all of those today. So we should, by the end of the session, have covered all of your questions. Just firstly, as Deborah's already said, but I will, a bit of repetition early on is always a good thing. Just so you don't think that it's a chap like the man on screen at the moment telling you how to go and raise angel investment. As I said, I've worked for an angel network in the Southwest, almost a decade's worth of experience in helping businesses raise early stage finance from 150 to £500,000. Over 70 million raised at Swain in the Southwest over its tenure, and in the last year helped Southwest businesses raise about 10 million quid. I run a pitching competition as well in the Southwest. It was run the first time in 2019, and the businesses that applied and went through, raised over £1 million following that event, and introductions made by myself and the team here. So hopefully you think I'm the right person to deliver this webinar session to you today. As Deborah's already said, what we're going to cover today, we're going to touch on the basics of angel investing briefly. We're going to assess how you assess the investability of your business, and we're going to help you develop or have an understanding of what a compelling pitch might look like. We're also going to help you with your proposition and make sure that you do and say the right things, that you stand out from the next person. Afterwards, obviously, you should have an understanding, therefore, of what investors are looking for, how to make it attractive to investors, how to pull a pitch deck together, and then the information that you need to go into there. So the basics. Now, I've got a lot of information in this webinar, so we are going to move at a pace. So please do use the Q&A chat function. I'll dip into it if and when I can, but we will have a session at the end as well. Unfortunately, angel investing is by far and away the hardest type of money to raise. And I would 100% recommend and or suggest that if you're a trading business, if you have some trading history, to look at other options first. Debt finance is a lot easier and a lot cheaper to raise than it is equity finance. You are, of course, selling a part of your business, so that's where the cost comes in doing this. And the difficulty is that the process can take an extremely long time. When I worked at Swain, the fastest deal we did was 11 days, but the longest was 11 months. So that should give you some idea of how long this process could take. General rule of thumb is it could take about 3 months from start to finish, but it obviously changes depending on the business and the investors. Are you the red dot in the middle? I'm sure pretty much all the businesses and individuals on this session today are in the outer ring and have the qualifying criteria, tick most of the boxes for angel investment. But at the end of the day, I'm afraid to say it is only a very, very small percentage that will get the money. I work on a 4% rule or a 1 in 5. So if we take 100 businesses that are interested in raising it, 20 would be selected to go forward to raise investment, and of that, 1/5 would actually raise investment. So from 100 businesses, you're looking at about 4% are probably successful, and that data comes from the 15 so years that Swain was running. Curb appeal. So what we're going to do is, I'm just to hammer home the point for you, I'm going to show you a bunch of houses in a second. A little off topic, I know, but hopefully it will get the point across. And then we're actually going to run a quick little poll. So I'm going to give you about 5 to 10 seconds to have a look at these houses, and I want you to just answer a quick question for me. So if we start having a look at those now, which one do you like and why? What do you like about it? There we go. So which house do you like and why? Now, I didn't give you very long to do that, and I'm sure we'll have the results in a second, but the point I'm making is, there we go, the Ivy house. Now, I only gave you 10 seconds there to have a look at those, and as you've already shown by clicking which house you liked, you made your decision. It is that difficult to raise angel investment. You have roughly that long before an angel might switch off and not be interested in your idea. So you must hit the home run quite early and get them interested in your business to want to continue to listen to you and maybe invest in this business. Still on the basics, classic equity plays, I'm sure lots of you will know, but if you don't, the red bit at the bottom is where the angel investment comes in. The cash goes out of their bank account, so that's where the investment comes in. In the middle, there's absolutely nothing going on, and the angel will get a big return a number of years down the line. Now, the size of that return obviously depends on when you sell the business to who and for how much, but that's a general classic equity play. Sometimes if the business is doing well, there may be some dividends in the middle. So there are circumstances where that will change and there will be a little bit coming back to the investor. But generally speaking, the investor will get a big payout a number of years down the line. There's 4 main parts to it that you should be aware of. The idea, what it is that you do, how you make money out of that idea, your route to market, and how the investor makes their money. And Marcus is going to throw up another quick poll for you again. Of those 4 options there, which do you think is the most important to explain to an investor? I'll give you a couple of seconds to answer that. Fantastic. Well, that's brilliant. I tell you what you've gone and done for me is you've gone and eradicated the next slide on my session. Yes, it is important, obviously, to explain the idea and how you make money and your route to market. But obviously for the investor, because you have to think about it from their perspective here, they want to know how they make their money out of it. So, Marcus, we don't need to worry about the next poll. Pretty much everybody's got that. So when you're talking to investors, don't spend a huge amount of time on what it is that you're doing. Make sure that they understand it, but make sure you complete all the parts of your pitch all the way through to the exit, and don't leave it out, because that's where the investor really wants to know where they get their money back from. Why do they invest? They want to make a return and they want to participate and contribute. That's it, pretty much. No excuse saying because returns are elsewhere or because SEIS and EIS are available to them. That's not why an investor will invest. Let's be serious here. They want to make money out of this, or they want to help. 2 reasons why. But it's got to be the right product and the right people, and it's got to add value. So do you do those last 2 things for them to invest? Typical investor aspirations: 5 to 10 times cash. Might hit home, might be a little bit heavy for you, and I'll give you an example later of what that would look like. But 5 to 10 times cash return on their investment. Everyone will say 3 to 5 years. You'll see I've put it in brackets there. 5 to 10 is probably a more realistic number, if not even a bit stretched further than that. 3 to 5 years generally is just unrealistic. Businesses don't have the opportunity to grow or attract an exit opportunity in that time. Obviously, they will want an exit. So if you're not planning to exit, then finding an angel investor is going to be nigh on impossible. They will most probably want a seat on your board, and they'll therefore want some influence and control. So you should be aware of that before you go into these conversations. Other considerations that the investor will have is the price at which they enter, their return, and obviously exit requirements, their control, the culture of the investor and the culture of the team at the business. Does it match? Interference from outsiders or the board representation, who's on it and why. Information requirements, what they want to know and what you want to know. The time it takes, I've already alluded to, how long it takes from initial conversations to actually completing the deal. The DD required, investment documentation, and any references. So those are all things that you need to think about as well. So we'll move on to those are the basics of angel investing generally. What we will move on to now is we will move on to assessing how investable your business is and what the investors are looking for. Unfortunately, as I've already said, we are actually looking for a diamond in the rough here. You know, not many businesses raise money. So how can you stand out? How can you assess whether this is the right journey for you to go down in the first place? And I'm going to start with, unfortunately, the one that most of you, if you've spoken to angels or you've tried to raise money before from angel investors, will have heard, is traction. I'm afraid there's no getting away from it. Traction is crucial to this. It's probably one of the first, if not always, one of the responses that will come back to businesses if they're unsuccessful. What does traction look like? Sales or trials or social media likes. different depending on the business. As you can see, I've done it in a little bit of a traffic light system there. Unfortunately, sales are the key to this. If you've got sales, you've got some traction. Trials are always a little bit interesting. If you've got somebody paying for a trial, then that's great. However, and unfortunately, if some of you are in this situation, it's my interpretation, my opinion, free trials are not worth anything. And the only reason that I say that is because I imagine lots of you will have done free trials yourself. And I'm sure you can think of an example where you've signed up to a free trial and then actually not used it. You're not paying for it. There's no push for you to use it. So somebody using a free trial or signing up to a free trial doesn't really count. You need to push for that income generation, even if it's a small percentage of the end cost of for the business, 20%, 30%, 50% of the cost price for the business, then you need to push them towards it. That's what will really attract an investor. Very few a number of businesses, obviously social media likes and things like that will be important, but please don't say we've got these many followers on Twitter and these many followers on Facebook, etc. Unless that is the real driver behind your business, it's pointless. Nobody really needs to know about it. It's the sales and the money in that we want to know about. But as I say, as a general rule of thumb, it's not the same for all. Why have you chosen? Choose some different metrics, and then why have you chosen those metrics? Are they industry standards? Do your competitors use them? Do they make you look better than your competitors? If you're talking about sales, have they turned? Have they turned in that hockey stick, which I'm sure you're all aware of? Have they gone from moving downwards on the way up? It's not friends and family anymore, or colleagues, or locals. You've actually expanded a little bit more and expanded your reach. Sizable base. So for freemium models, investors, as it says there, probably looking to hundreds of thousands to 1 million per month of users before that's considered traction. You can look at the average sales price of a customer, or have you got some major brands or big businesses backing you, or key players in the industry backing you? Those are all things that would count towards traction. But I'll say the same point again. Have you made some sales? Are they profitable? Are they recurring? That's the gold standard. That's what you should be aiming to achieve before you consider going down this route. The trifecta. So before you even start moving on to this, have you registered your business, or are you trading as? Have you secured that name? Have you got your domain name? And have you got your trademark? If you haven't, you're in trouble. Number of businesses I've come across, not just recently, but going all way back, have a conversation with them. This is what we're doing. This is what we're called. Great. This is our website. Fantastic. Where's your trademark on your business name or your logo? Haven't got it. Do a bit of research, and believe it or not, there's somebody else operating in the UK with a similar trademark or has already trademarked the name. That's screwed your business from the start. It's very easy. It's simple, and it's free to check. Go and have a look. Trademarks do not cost a lot of money. Get yours secured so you're in a great place to start before you move on to speaking to investors, because they will want to know that you've got the business secured. And if somebody else can trade under your name because they've trademarked it and you haven't, then your business isn't going anywhere to begin with. IP is another question that we will ask, or investors will ask. What IP have you secured? Have you got any patents? Have you got any trademarks? Have you got design rights? Is there any copyright in your business? Or have you got trade secrets? Some of you may know the story of Trunky and their design right. A competitor came out with a pretty much identical looking product and took it all the way through the courts, and they were sent back. Trunky couldn't protect it, and now there is a pretty much identical replica out there in the market. Don't know if anyone knows this story, but KFC, their breaded cover of chicken is a trade secret. So they actually patented somehow the process of cooking chicken in a breaded coat, but within that patent weren't the ingredients or the makeup of that. That is a trade secret, supposedly noted down on one scrap of paper. So whichever route you wish to go down or are going down, make sure you've explained it. Make sure you've outlined why you're going down that route. Make sure you've costed it. Make sure you can explain why that's the route that you want to go down. Do a timeline. looking to the future and say this, we're going to take this option at this point, we're going to patent at this point, or we've already started that, we're operating off trade secrets at the moment. All of these things, make sure you can explain why you're going down the route that you are going down and the IP protection that you have decided to secure. How investable is the team? This is massive for investors. They have to like you. They have to like you as a person if they're going to invest. Business is a people business. You have to get on with the investor, and that trust works both ways. You have to trust the investor. Don't think this is solely on you. When you speak to an investor, if they're interested in investing in your business, you need to ask yourself the question, do you trust this person? Do they trust you? Because if they don't, it's going to be a rocky journey and a rocky relationship, and it probably won't work out in the long run. But with regards to the people and the internal team, who are they? Why are they decided to do this? What background have they got? What relevant experience? Are you approachable? And that's what I was talking about. Can you stand up in front of us, in front of a room of investors, or speak to people and not turn them off, not scare them off? Are you adaptable? A number of years ago, Dragon's Den, I hate to draw attention to it, but a perfect example. 2 finalists got to the end. Alan Sugar asked the one chap, he said, I really like your business. I really like you. I think this is going to work, but I've seen these types of businesses before and they don't really work because of X, Y, and Z. He's obviously had his team look at it and understand and done some research behind the scenes. He's gone to the chap and he said, you need to change it and we need to do it this way. It's the only way I think it's going to work, and then we'll move forward. And the guy wouldn't budge. And they must have had a 2 or 3 minute conversation. The guy wouldn't budge. So Alan Sugar fired him and went with the other person, invested the other person. You have to be able to adapt. Don't think you know everything. Investors have got to their position. They've got the money they've got behind them for a reason. They've maybe run businesses in this sector before. They've operated businesses in this sector before. They've sold a business in this industry before. They've got some serious experience potentially behind them, business acumen. If they say you could do it this way or look at it that way, have a conversation about it. If you still disagree with them, come back with some evidence as to why you think that's not the right way to go. Please don't just discount it. It won't look right. It won't look good. And the investor will probably just think you're unadaptable and move on to the next opportunity. Are you trustworthy? Bit of an analogy, really. You know, the investors are, imagine you're the pilot of an incredibly fast jet. Your business is the jet, and the investor is putting in the jet fuel. Are you the right person? Can the investor trust you to take this plane up into the air, fly it around for a little bit, and then bring it back down to earth safely? Would they put that fuel in your jet? Are you a trustworthy person? And are you honest as a team, even with yourself, before you go on this journey? Are you going to stand up there and when I or investors ask questions about your business, are you going to be honest with them? Because if you're not, they'll be able to read it in you. They'll be able to read it in the documents that come through later on. I do have conversations with businesses where I ask about sales and I ask about the route to market or whatever it might be. And you can tell, some of you will have had these conversations where you speak to somebody and you can tell they're lying, or you can tell they're making it up on the spot. Not a great place to go. Be honest. If you don't have the answer to the question, say you don't. Say you need to go and research it, or say you need to go and get the information. Don't make it up on the spot. Investors will probably read through it and you'll have killed the opportunity. And then move on to the next one. The opportunity. So how investable is the opportunity? How big is it? We'll touch on this again when we talk about pitch decks, but how large is the opportunity? How big is the market size here? Have you got any evidence for your route to market? Because as I already showed earlier, route to market is an option that an investor will ask. And of the 4 parts to equity, explaining your opportunity, how you make money out of it, route to market, and how the investor makes money. Unfortunately, the last 2, although the last one is the most important to the investor, The second last one, route to market, is not far behind it. You've got this opportunity, you've got this business, maybe a new business, you want to grow it, you want to take it on to the next level. Can you explain with evidence, with examples, why or how you will succeed in getting to the market and growing into this business? That's what you have to be able to do. And you've maybe got a USP. How do you capitalize on it? So you need to be able to explain that, and we will touch again on it again, as I say, on the market and how you explain the size of the market in a little bit. So my approach, as I say, I assess businesses whether they're appropriate for angel investment. That's my job. If we do end up speaking, if we have spoken, you might understand some of these questions. If we do end up speaking, I will be asking you these questions. There are obviously more to it, but this is pretty much the first 4 that I'll go through. I'll get you to talk to me. I'll say, look, don't leave anything out. Take me from the start, where you got the idea from, where you got to, and where you're going. I want to understand what the value proposition is. I want to understand what the business is doing. I want to understand what makes it different. That's the first bit that you have to be able to do. Can you do that succinctly? Can you do that quickly? Can you do it accurately? I have sat on calls where it's taken 45 minutes and I still haven't quite understood what the business is. It's my job to listen to these businesses. It's not the investor's job. They will not listen for that long. You have to get your point across quite quickly. You have to get them interested, and then you can go into more detail. Please don't bombard them with a huge amount of information to begin with, because they'll just get bored. You've just got to hook them in, get them interested. If they're interested, they'll ask more questions. But from my approach, first thing to be able to do in 5 minutes or 10 minutes, maybe, you should be able to explain exactly what you do really easily. Imagine you're explaining it to a 5-year-old. Start there. Explain it to a 5-year-old. If a 5-year-old would understand it, then you can probably build on it a little bit, but you've got the level at which you need to start, because not all investors will be experts in your industry or your sector. Second question I'm going to ask, as we've already mentioned, I'm going to ask about your traction. I'm going to ask about your turnover. I'm going to ask whether you're profitable. I'm going to ask whether it's recurring revenue. I'm going to ask about your previous 2 years, turnover for 2 years ago, turnover for last year, and your forecast for the next couple of years. I'm going to ask about your margins. You need to have this information to hand. You need to know this information. Valuation and money, 3 questions that I will ask. How much do you want? What do you want it for? And what's the valuation? What's the equity on sale here? And I will give an example of the maths that I do behind that to come into valuation. The fourth, final one before I move on to other ones, IP. What IP have you got? Why have you gone down that route? Have you patented it? Have you trademarked it? Why? That's my initial approach to asking businesses whether, and making a determination on whether I think they are investable. If you do the first bit in 5 minutes, if you've got some traction, if your valuation isn't ridiculous, and you've got some IP, then we're onto a bit of a winner here, potentially. Some of those you might be able to drop out. You might be able to lose one of those, depending on which one it is. If you can explain your way around that, or if you've got the evidence to back it up, then maybe it's still a goer. If you're missing 2 of those, if you can't explain your idea quickly and you haven't got any traction, no go. If you can explain your idea and you've got some traction, but your valuation is crazy, investors going to be turned off. So Q&A so far. I'll jump into the chat very quickly. See if there's anything there. Loving the polls, fantastic. Okay, no worries, no questions there. We'll move on. So a compelling pitch. This came up in our quick Slido poll. What do we have to say? Now, I'll caveat this. I will give you a very brief overview of what I would expect to see in a pitch document. All the slides, I think there's about 12, maybe 11, if you discount the last one because it's not required. Some of the which I've already explained. So we've gone through the team, we've gone through traction. So I'm not going to go over those again, but I'm going to try and fill in the gaps that we haven't covered. 3 ways that you can develop your pitch. You can have a short one, 30 seconds, minute. You can have your formal investment pitch, a 5-minute one, you have a 10-minute one, or you could have a 20-minute one, something like that. And then you've got your written business plan. Work it from the bottom up or work it from the top down. Don't mind which way you do it. Obviously, you've got to have your business plan. Don't make it up on the spot. Work from your business plan, develop your formal pitch, and then drill it down into the really key hit home information in your short presentation. So there we go. That's what you need in a pitch deck. 12 slides, title slide, elevator pitch, value proposition, business or revenue model, traction, the market, competition, people we've already touched on, the finances, the ask, and your exit, and then closing slide if you feel you want one, but it's not essential. I've put them in that order. You could change them around if you think some are more important than others in your team, in your business. Seen people be higher up, so I've seen businesses start with people, or not long after the value proposition. Team might be a big part of that, so you can move them around, but that general rule of thumb, that's a pretty good way to go. 11 to 12 slides in that order should give you a pretty good coverage for a pitch deck. Simple starting block, business model canvas. Probably heard about it, probably done one. If you haven't, look it up, watch some videos, complete one. Great place to start to cover pretty much all the sections that you'll need to understand, and then divulge that information into a pitch deck. Hit your home run early. Get your big points out there. If you've got some great points, if you've secured your patent, if you're selling to Amazon, if you've got X amount of turnover, if you've just secured a massive deal, get it out there early. This is the biggest thing to getting an investor interested. They will see hundreds of opportunities a month. You've got to get them interested. So give them an initial outline, explain the problem in the market, back it up by evidence, highlight the traction, and then close that initial slide quite quickly. What I'm talking about here, as we'll just go back to it, is your elevator pitch. All right, 30 seconds to explain very briefly what it is that you do, explain the problem, back it up by evidence, explain your traction, and then finish, and then move on to the next slide, which is your value proposition, where you can then go into a bit more detail. Value proposition canvas tied into the business model canvas. I would 100% recommend and suggest you go away, complete one of these, complete a number of these if you've got a number of different products or services, and tie it all into your business model canvas before you develop your pitch. Make sure you understand and can explain clearly what it is that you are offering to businesses or to individuals. I said we'd come on to market and route to market and how we might explain this. Lots of you will have seen the option on the left, and it's one that I always see. If you don't know the acronyms, go and have a look at them. But total addressable market, 100 billion. Everyone always says it's a massive, nice, big number, because guess what? They believe angel investors want to know that that's the size of the market. They want to know that it's a massive market, and they do. They want to know that your business can grow into this. The serviceable addressable market, 200 million. Again, big numbers. Yes, great. Our business is going to grow and we're going to service a percentage of this, which is SOM, 20 million. So the serviceable addressable market, obtainable market is 20 million. That's what we're going to go and secure. Great. Big numbers. That's what everybody thinks angels want to know about. It's a load of rubbish. In my opinion, it's just big numbers. I don't know if you can go and achieve that. I don't know how much they pay per product. I don't know how easy it is to get into that market. So I would suggest that you have those numbers in your mind so that you can explain the size of the market, but have a look at the one on the right and see if you think this is a potentially better option to drop in there as well. Start at the bottom and work up. Our product is this, it's 10 quid per product, and customers per annum in our market make about 100 purchases per annum. So 10 quid, 100 purchases per annum per customer, and we've targeted 1,500 in the first year. So in our first year of trading, if we secured 100% of the targeted customers, we'd be at 1.5 million turnover. Much easier way, much more relatable to the investor to then to get a grip and an understanding of how you're going to build into this market there, rather than 20 million, or we're going to service 100 billion worth market of X. Work it from the bottom up if you can with the detail. The finances, I would expect 5 years of financial forecasts, profit and loss, balance sheet, and cash flow. I'm not expecting them to be monthly. I'm probably expecting your first 2 years to be monthly. So years 1 and 2 to be monthly P&L, balance sheet, cash flow forecast. Year 3 and 4, you can probably go to quarterly, and year 5, you could probably have as a yearly summary. You could have years 4 and 5 as a yearly summary as well. It's a long way out. They're never right anyway. So years 1 and 2 quarterly, monthly, year 3 quarterly, year 4 and 5 could be just a yearly summary. But 5 years of financial forecast is what you'd be looking for. The ask, right, valuation, this was asked about. What do you ask for? It's up to you at the end of the day. I'm not going to tell you what is right for your business. But to give you some examples, I did just a little bit of research on Dragon's Den. 100k for 5% of the business. That's a £2 million valuation on the business, just so you know, doing the maths. £2 million. And the business had 200k turnover, 60k net profit. So if your business is turning over about 200k and you've got a 60k net profit and you're asking for 100k for 5% of the business, again, I can tell you right now, you can go and watch it. The Dragons laughed at them. Laughed them out of the building. Middle one, 200k for 5%. 0 sales. 4 million valuation. It's ridiculous. It's too expensive. There's no sales there. There's no way you can justify that level of valuation at that stage. And the last one, 75k for 5% at 1.5 million with 600k turnover. Interesting thing about this is it was only 22k net profit. If you'd up your net profit margin a bit, I'm sure they probably would have had a conversation around evaluation and maybe tweaked it, and the investor would have come in at a higher percentage. But 22k net, asking for that valuation and then attempting to justify it when the investors asked and discounting their theories and thoughts, just turned them off and didn't work for them. At the bottom there, you'll see typical investor expectations or aspirations are between 10 and 40%. You should be operating between 10 and 40% in your valuation or your ask. Exit strategy. Lots of you may have heard or might be thinking about just saying, yeah, we'll go for a trade sale or an IPO in 3 to 5 years' time. Or I've heard it before, I kid you not, we'll sell to Google or we'll sell to Facebook. Or it's worth billions, so somebody will buy it. It's not going to fly. It's not going to work. It's boring. It's been done and nobody believes it because it doesn't happen these days. Very, very, very rarely does that happen. So what do you put in your exit strategy? Exit strategy A, triple plus, whatever it might be. When you explain you're going to exit, who are you going to exit to? Don't say Google or Facebook. Give real examples of somebody in your sector, in your industry or related that has been buying businesses recently. They're actively seeking out businesses to purchase. Why would they do it? And when? Now, there's nothing wrong. If you haven't considered it yet, you haven't got there, there's absolutely nothing wrong at all with the bit at the bottom. We'll consider an exit at the appropriate stage or at the appropriate time, but envisage it could or should or might look like this. You don't have to give a firm answer when asked about it. But if you do, and if you want to, which you should give examples. We're going to consider an exit at the appropriate time. The likely businesses to be buying us or that we would exit to are ABC Limited, XYZ Limited, because they've recently been buying businesses. Typical valuations on these businesses are X, Y, and Z. Much clearer way of explaining what it is that you're going to exit for. Other considerations when you're pitching. Q&A. Do not miss out on the Q&A. If you have a slot for Q&A, leave it there. Make sure you get to it. Don't eat into it. Get your big wins in early. Timing. Practice a 30-second pitch, practice a 5-minute pitch, practice a 10-minute pitch, and practice a 30-minute one. Presenters, are you going to present with 2 or are you going to present with 1? If you've got the time to practice it with 2 and you can get it absolutely nailed on, do it with 2. Personally, don't like it. Always go with 1. Have the second person there. If they bring something, if they've got the knowledge to answer some questions, bring them in for a question. Nothing wrong with that at all. But don't present with 2 people generally. It can get clunky. It can get messed up. Timings might go and you're losing seconds. Get some perspective. I've already said be honest with yourself. Take a step back. Are you at the right place? Can you answer these questions? Ask questions of the audience as well. So if you've just started your presentation, you've got a 10-minute slot or a 5-minute slot, you've done your value proposition and you've done your initial explanation of what it is that you're doing, stop for a second, ask the audience. Hands up, or does anybody not understand what I've said? If somebody puts a hand up, answer it. Make sure that everybody understands. If you've lost them in the first minute, you're never going to get them back. Nothing wrong with just saying, does everybody understand? Does everybody got a clear understanding of where we're going with this, of what our product is? Nothing wrong with doing that at all. Q&A coming up again. Do not miss out on your Q&A. You're going to tell the investor in your pitch what you want to tell them. In the Q&A, they're going to ask you what they want to know. Do not miss your Q&A. Put some special content in there. You're going to use videos. Make sure they work. Don't talk too much. I know I'm throwing lots at you here. If you've got them interested, if you've got them asking questions, leave it there. If you've got them to take a bite, leave it there. Say you'll send them the documentation. Say to pick up another time. The more you talk, the more chance you've got of saying something stupid or saying something wrong that's going to put them off. That's all they're looking for. They're looking for a reason to say no to your business. So if you've got them interested, see if you can delay it to another meeting where you can go away, prepare your next bit, send them some documentation. Take your time. Don't rush. Don't panic. They know you're in a crap situation, stood up there in front of them or on the screen in front of 100 people. Take your time. Make sure you practice. Branding or what you look like. If you're a plumber and you're looking to raise investment and you've got a great business that can do it, don't turn up in a suit and tie. Doesn't fit the look. Have a nice branded t-shirt on. It goes with the business. It fits, and that's who you are. Don't try and be something you're not in front of these people. Be honest and be open when they ask you questions. If you don't know the answer, tell them you'll come back to them or tell them to pick up afterwards. You might find occasionally that someone will ask a difficult question. There's always people out there that will want to do that. They'll want to pull you down. They'll want to break you down, and they'll ask a really, really difficult question. Or they'll come up with an example that really knocks you backwards. Tell them to pick it up afterwards. Nothing wrong with saying, I think we should pick this up offline. I haven't got the answer for you now, or I'd like to speak to you privately. Nothing wrong with that at all. And finally, Q&A. Don't miss your Q&A. Q&A so far. So let's have a quick look. Yes, the slides will be shared afterwards. How important is recurring revenue? Is there recurring revenue in the value chain and your product improves? Inquirer, would that work? Yes, recurring revenue is important if your business model works towards recurring revenue. Get it in there. If it's not, then don't change your business model. If it's not right to aim for recurring revenue, but obviously it's a lot more difficult to constantly go on that sales cycle. So if your business model adapts to it, or you can introduce it, an option to attract recurring revenue in your business model, secured recurring revenue, it's a great way to go, because it just shows the money's going to continue to roll in and you haven't got to spend most of your time out there selling. Click back on the slides, Edward. Right then, what makes you different? So stand out from the crowd. Hopefully that's clear what it is. That is a hockey stick. As I said earlier, lots of you will know what I mean when I say hockey stick, and lots of you will have forecasts that look like a hockey stick. Absolutely nothing wrong with that if they are realistic, if you can evidence them, if you can back them up. Now, I know kind of contradictory, because I've already said that forecasts are made up and they're never right, but don't say you're going to turn over £10 million in year 2 if you're at 0. Unless there's unless in the last month you've grown to a couple of million users or purchasers, and you can show that actually, yeah, we're going to move on that route, it's not going to happen. Be realistic with your forecasts. Look at competitors, look at their company's house records, do a bit of maths, see if you can figure out if they've been making profit recently and how much the market is growing. Lines, not dots. Communication is what this is about. I have conversations with businesses all the time, as I've said, and at this point in time where the yellow dot is, they are doing X in terms of performance. Might be rubbish, might be good, might be great, but at X point in time, they are there on the graph. Now you're going to speak to an investor at some point, and at that point in time, you're going to tell him or her that you are doing this level of performance. And what are you going to say after that? You're going to tell them that's where you're going. As I've said with your forecasts, you're going to say our business over time is going to improve. It's going to be great. It's going to go in this direction. Everybody's going to love it. However, you've only spoke to them once. They are going to look at this and are going to go, I think it's going to go down. I don't think this is the right business. I don't think it's the right team. I don't think you've secured your IP, whatever it might be. You have no other evidence to show that this is going that way because you've only spoke to them at this one point. So communication, stand out. What should you do? Speak to them over lots of different times, lots of different periods. And I kid you not, my role, as I've already said, is to help businesses raise money, is to interact with these businesses, to give them advice and to make introductions where I feel appropriate. 99% of the businesses that I've spoken to, when I've said, keep me updated, have not. Now, I know that I'm not an investor. I have invested in the past. I'm not currently investing, but I make introductions to investors if I think it's appropriate. And yet businesses still don't send me updates. There's nothing to stop you making a list on an Excel spreadsheet of every investor or anybody that is able to put you in front of investors and send them a monthly or probably a quarterly newsletter or an email or an update. I spoke to you at this point. Look where we are now. We're going in the right direction. Don't be afraid to put in a setback. This is where we're going. This has happened. This is how we're reacting to it. They will like to see that. It's only going to enhance their trust in you and make them believe that you're an open, honest person that's willing to communicate. Because believe it or not, if they invest in you, that's what they want from you in the future. They want you to be open and honest, and they want you to communicate. So lines, not dots. Advisors and NEDs. Have you got one? If not, should you get one? Maybe. Are they from your sector? Are they an expert? Yes, great, go for it. Are you going to pay them? If so, how much? If you are, or if they've asked for money, give them a time frame, give them a contract, give them targets. Don't just pay them and leave them there, because after 12 months to 18 months, generally, you've got all you can get out of an advisor. After 18 months, there's not much more that they can give you. So give them targets. If they're not hitting it, they're just taking your money. If they are hitting it, obviously it's great to keep them on, but keep an eye on the end point. All right. Make sure that they are continuing to deliver value, because after that 12 months, 18 months, there's not much that not much more that they can give you. It's probably worth bringing in a bigger player to help you out on that next stage. Re-engineering, right, this is going to tie into valuation and probably one of the most important bits of this presentation. So I hope you're all still listening, because I'm also going to ask you to do some maths and we're going to have some more polls. Quick caveat, once you understand this, don't start with this, all right? You need to forget it quite quickly. Your business is business A at the moment. You're turning over £60,000, but you're making a 10K loss. Now, I say this is your business. You might be doing better than that. You might be doing worse. But for this example, you are business A, 60K turnover, £10,000 loss. In 4 years' time, you have to be business B, or you want to be business B. What has your turnover got to be, and what has your profit got to be to get the investor their return? That's what we're going to go through now, all right? And how I look at it and how investors will look at this. So your business A, 60K turnover, 10K loss. You've asked for 75 grand to grow your business, and you're going to give away 25% of your business. In 4 years' time, how much is that 25% worth? If 25% of your business is worth 75k now, what is 25% worth in 4 years' time? Okay, sure, we'll have some results of that. Just see what we think. I'll explain my thinking behind it. 300k, very good. So everybody that said 300k, spot on. Simple rule of thumb for this: the investor will want a return equivalent to the number of years that they are invested. So if they want 75k, if you're invested for 4 years, you want a 4 times a return. If you're invested for 3 years, you want 3 times, 5 years, 5 times your money back. So 75k for 25% in 4 years' time, that 25% must be worth £300,000. So if in 4 years' time, 25% of your business is worth 300k, what's 100% worth? Let's do some more maths. 25% of your business is worth 300k in 4 years' time. What is 100% worth? Well, bloody hell. Wow. Very good. Gold stars, A+ all round for all of you. Great stuff. Your business, 100% of your business is worth 1.2 million. Now, the way that bigger businesses are generally valued is their profits are multiplied by something called a price earnings ratio, a PE ratio. These figures are generally between 4 and 10, generally. Certain sectors, certain big businesses might be larger than this, but as a general rule of thumb, between 4 and 10. So we're going to take 6 for this example because it's still early and it keeps the maths nice and simple. If 100% of your business, the valuation of your business, 100% is 1.2 million, what level of profits must be multiplied by 6 to get to that total? I've done the maths for you. I'm not going to ask you to do that. It's 200k. You must be making £200,000 post-tax profit to have that 100% valuation of 1.2 million. Really, hopefully, to show you how much or what this means for your business as well. Post-tax profits, as a general rule of thumb, are about 10% of sales. If 200k is your post-tax profit, and that's 10% of your sales, in 4 years' time, you must have a £2 million turnover. So you're currently at the business A, you're 60k turnover, you're making a 10k loss, you want 75 grand for 25% of your business. In 4 years' time, for the investor to get the return that they want, you have to take this business to a £2 million turnover, 200k profit, net profit, post-tax profit. That's the job that you've got to do. And that's why the investor is asking the questions that they are. Are you the right team to do this? Can you achieve this? Is the market big enough? Is the market adaptable enough? Is the market interested enough? Is the product good enough? Have you secured your position so nobody's going to take your market share? What's your route to market? Those are the questions that are being asked. Just so you know, we'll go, I'll take you back very quickly to those Dragon's Dens examples that I gave you. So 100K at 5%, if you did the maths on that using this formula, for a PE ratio of 4, so not 6, 4, the business would have had to have been turning over £20 million in 4 years' time. The middle one would have had to have been £40 million, and the last one would have had to have been £10 million. So just the business has to grow so quickly for the investor to make their return on that 5% in those examples we gave earlier, that it puts the investor off. And that's why between 10 and 40% is a general rule of thumb that you should go with, because they're quite manageable. The numbers are a little bit more manageable. Stand out again, still stand out here. Know your stuff, know your terminology. Difference between value and price, what you set, what somebody's willing to pay for it. Pre-money, post-money valuations, hurt money or envy ratio. Pre-money valuations, if you want 100K for 25% of your business is worth 400K. That's a post-money valuation. Pre-money valuation is 300K. The only difference is that the 100K is not in your bank. And that's something that that's maths that I will do in my head. Take you back to my questions earlier. When I ask you what money you want and what the equity sell is, I'll do the straight maths to get to my valuation and then ask whether that's pre or post. Envy ratio, you're asking an investor for 100K for 25% of your business. You're telling them to value your business at 400K, but you've only put in 6K. You've got 75% of the business. You yourself are valuing the business at 8K. You're asking the investor to pay 50 times the amount that you've got there. So what can we do? You could drop the amount that you're asking for, potentially drops the valuation they've got to pay. You could take a personal guarantee. You could put more cash in. You're now asking, you've now put in roughly 41K. You're asking the investor to pay 7.5 times the amount. Much more manageable, much more understanding from their point of view. These are from Rod Beer at the UK BA. I suggest you look them up or connect with him. You can leverage your investment. So let's say you get some investment, or you've had some investment in the past. Go to a match fund, go to an angel co-fund, get some match investment from the British Business Bank to that angel investment. All of a sudden, your 100K pot has gone to 200K. Maybe you're interested in a grant. Maybe you get a 100K grant. Now your pot is 300K. And maybe you've done some research and development, or you've got patent box or something like that. You've got some R&D tax credits and you've got 20K back. Your 100K has gone to 320K. You need to be looking at all these things. This is only going to strengthen your pitch to an investor and make you stand out from the crowd. Don'ts. Real example, in a room with business, with investors, talking about the tax liability on some of the products, and the company said, we'll wangle it. Killed the deal right there and then. Somebody turned up in a Hawaiian shirt. Don't do that. And somebody was late to an investor meeting because they didn't want to pay the price, travel to London in rush hour. They wanted out of hours ticket, and they were late. Don't do that. Due diligence, you can start this now. If you haven't, I suggest you do. Set up an online folder or even a file of facts in your home or your office. Put your financial DD together, get your legal DD together, your commercial and your personnel DD. All of those things, all your contracts, your certificate of incorporation, your patent filing, all of it in a folder, so that when you speak to an investor, if they're interested, you can simply send them the folder, you send them the link, the Dropbox link, whatever it might be. Here you are. Here's all the DD that we've done. Saves them the time, makes you stand out from the rest, because lots of people don't do this. Legals and transactions. Know what you're talking about when you're talking about a shareholders agreement or a subscription agreement, your articles of association and warranties and indemnities. And have a look at, apply for EIS or SCIS. Tax breaks for the investors. As I said earlier, it's not the reason that they would invest, but it's a nice to have for the investor. They get tax breaks on their investment, and pretty much all businesses that are looking for investment will have this. If you haven't got it, you won't stand out, or you at least won't be up with the pack itself. So we've gone through a lot of information now. I do apologize about that. Hopefully some of it or most of it, if all of it was interesting for you. To assess the investability of your business, look at traction, look at your IP, look at your people, look at the size of the opportunity, and look at your valuation. Pull together a pitch deck, title slide, elevator pitch, value proposition, business model and revenue model, traction, market, competition, people, finances, the ask, and your exit. Stand out from the crowd, communicate realistic numbers, re-engineer them, go through the process that we just went through, and then forget about it. Don't start your numbers then with the perfect figure, because it potentially won't look achievable, and they'll ask you why you've gone for that figure, and you won't be able to say, oh, the market just won't back it up. So have it in your head as an understanding of why you're going to go down that route, but don't then produce your numbers just to match it perfectly. Understand your terminology and look at leveraging any investment or any monies that you've already raised so far. And we'll move on to any Q&A. Thank you very much for listening.
Thank you, Ed. I think that's been a very thorough run through. We've got a few questions coming in on the Q&A and on the chat, but I am aware of the fact we've hit an hour.
I know, sorry about that.
So very aware of the fact if we have got people on with us who do need to leave, please do feel free to head off. The session is being recorded, and that recording will be made available to you all, so you can always catch up on the Q&As later, but we will go through a few questions, but please feel free to leave if you need to. But other than that, we will head into some questions. So Ed, we've got a few questions coming in. So one from Diana: what finance projections would you expect from the R&D stage startup?
What finance projections would you expect from the R&D stage startup? I would expect 5 years forecast. 100%. I know it's finger in the air, and most probably you're going to have 1 or 2 years of zeros. The investor will expect that, but the key thing is with R&D stage startups is you have the number of years forecasts or projections that take you through revenue generation and to profitability, or where the hockey stick starts turning. I've said 5 years. If you start generating revenue in year 5, then it'd be such a small number, and the investor's going to want to know what happens after that. So unfortunately, if your time to commercialization and revenue is a significant period, you're going to have a lot of forecasts, but you need to be able to explain where that curve is and why it happens. Hopefully that answers that question.
Lovely, thank you, Ed. Another one coming from Hugh: valuations, what multipliers are there for software plays versus service plays?
Oh, so SaaS models, there's a formula. I'll have to look it up, and I'll get it sent out to you exactly how it works. It's a percentage of the recurring users that you have on SaaS models, and things like that aren't done by revenues. It's a percentage of the users that you have on a monthly basis multiplied out. I will get the well-known general rule of thumb to you when we send out the slides, because I haven't got it straight off the top of my head at the moment, but it's a percentage of the monthly users multiplied out. So that's what you're looking at from the SaaS model.
Perfect, thank you. We've got another one here around exit strategy. Can you talk a little about second and subsequent rounds of financing as opposed to trade sale?
Of course you can. Yes, definitely. Well, I can talk about it if that's what you want me to do, or if sorry, I'm confused slightly as to whether you're asking whether you can talk about it or I can talk about it. I'll answer both of them for you. Of course, you can talk about it. When you're talking to investors, you need to raise the possibility of raising further rounds. They will want to know about your fundraising journey. They will want to know, because at the start, as I say, one thing I did leave off there actually is when I ask you how much you want and what you want it for, I'm going to ask you about your runway. So I'm going to ask you how long it lasts. If it lasts 6 months, if it lasts 18 months, You should know this, and it should obviously be built into your projections and your forecasts. The investor is going to want to know, because if they've invested in your business or they're thinking about it, they're going to want to know when they have to put more money in, or you're going to be asking for more money and they potentially might be getting diluted. What they're also going to be concerned about, as I said, is because raising money is almost a full-time job in itself. So if you have to go through multiple rounds of raising money, you're going to be distracted from the business. So the investor is probably, although lots of businesses always ask for lots of money, and they want you to justify it. If you're asking for a smaller amount, they'll probably say, why that little? Things, a great rule that I always go by, things always cost more and take longer than you think. So if you're asking for 100K, an investor might say, why 100K? Can you actually do it on 100K? Why don't you go for 150? Because if you go for 100K, it means you're raising money again in 6 months' time. And that means that you've only actually got to work on this business for 3 months. And then that you've got another 3-month journey of trying to raise money and distracting you from actually delivering on the business. So yes, talk to them. They will be expecting it. From my perspective, yes, you should be looking at raising further rounds. You don't need to go into too much detail about what they are. It's very much, look, I'm looking to raise my seed round or my early stage investment from angels now at 150K, 200K, 250K, whatever that might be. We'll look to raise a Series A in X amount of months or years, whatever that might be, based on how you think your business is going to perform and the runway in which the cash that you're looking to raise is going to give you.
Lovely, thanks, Ed. A very quick one now. We've been asked, what was that guy's name again? Rod Beer. So
Rod Beer, yes, Rod Beer from the UK BAA.
So that was a quick and easy one.
Cool.
Now we've gone to the exact opposite extreme. Here's quite a long question, so it's in the Q&A if you can read it too, but I'll read it out for everyone else.
Sure.
Hi, Edward. I have a question, and it's more on the legal side, but I would like to know how it is from the entrepreneur side, the experience and the process from basically to raise first funding round through convertible notes or safes. They already have strategic partners and investors. Please help me understand how long the process is, and what are your recommendations to do it as efficiently as possible?
It's not for me. It's kind of a cop-out answer here. It's not for me to advise you on that to that level of detail, I'm afraid, Hans. You need to speak to an accountant. You need to take some legal advice on this. There obviously will be tax efficient and just generally efficient ways of doing this. Unfortunately, there's no way that I can give you a specific answer about that without knowing more detail. And as I said, it's not my place to answer those in that level of detail. The one thing that I would say, as I say, is speak to an accountant, speak to a legal advisor, have a look at it. Friends and family rounds are great. Interesting that you'd be doing it via convertible. Obviously from the friends, potentially family, I would have thought would probably go in for equity. It's a great opportunity. The future fund that was just brought out was a convertible, but you need to take some proper legal and financial advice on that.
Lovely, thank you, Ed. And now from Daniel, what should the business look for in an angel to bring versus a venture capitalist?
Okay, so they're completely different things there, Daniel. You would very rarely be looking at a comparison between them. An angel it could be any one of us, and we'll have a little bit of cash set aside. I don't know a huge number of people that have millions of pounds available to invest as free cash. So when we're talking about investors making investments, we are actually talking about free cash, not savings for their next holiday. We're talking about, you know, as you and I, or lots of us will know them, we are actually talking about free cash that is just lying around that they are happy to lose. So angels will typically invest between 10 and 20K themselves. A VC, a venture capital firm, will be investing million plus. So the two rounds are completely separate. Angels will come in at that earlier stage, probably up to around, depending on where you are. London is obviously higher, but generally up to around 500k is your angel investment, and that's your early, at an earlier stage of business, and for a higher percentage of the equity, because it's a riskier investment, the angel will be looking to, or you should be looking for, at least one angel to be called a lead angel, is what they call them, and they should have some experience in the market or the industry, or have sold or run a business in a similar sector. That's what you're looking for. Now, if you haven't got that, then some cash, as I say, just from a generic angel, shall we say, it is great. But 99% of the time, I understand and I hear that businesses that raise money say it's the input that the investor can have. So angels will look to have an input. They will look to help because they've invested in your business. So they will want to see you succeed. So that's what you'll get. VCs, much later round, million quid plus. So they're not really a comparison from what you're looking for there.
Lovely. We've very nearly run out of time, so
sure.
I think we've got 3 questions still on screen. If you can be really quick, we'll squeeze them very quickly.
I really want to register a patent, but guess the cost will be high. Present time the budget is still loose and running out of money to continue. It depends how crucial it is to your business going forward and protecting your route to market. You have to look at that versus the cost. I think businesses should be focused on the cost of money. High risk reduces. You should be able to refinance for lower cost longer term. Yes, of course, 100%. As I say at the start, if you can raise debt, raise debt. If you can get a grant, get a grant. Equity is the most expensive type. And how would you value pre-revenue and justify it? Exactly the same way, Steve. As I say, with the numbers, justification is very difficult. You have to look at other examples. Oh dear. We're still live. We might have gone.
We are still live.
Oh, we're still there. We're still there. My screen just went a bit funny there. You have to justify it with examples that are out there in the market, Steve. Look at other businesses that are out there. Other examples of businesses that have been sold or their routes and the timing that it takes them to get there. But simple. This is what I want. This is how much for, and this is our route to market.